we are going to break down the VA assumable loan process. Now, this video is really designed for the buy side of things, but sellers, pay attention, because if you're offering this, you also need to know how it works, so you're not thinking that, oh, they're asking me for all this stuff and it's not needed. So we're going to go over 5 steps. Step 1 is you do need to get a pre-approval. Servicers love denying assumable mortgage candidates. We see it all the time, and a pre-approval will help you fight that. And I'll tell you this, we do this as a free service right now to people looking to get an assumption. We'll do a pre-approval for them. And I'll tell you that half of those clients that were pre-approved to do a mortgage were denied by the servicers, but 100% of them closed. Why is that? Because we read the VA handbook, we know how it works, so we can pinpoint to you to show you, like, well, this is where the servicer is wrong, and this is where you can do that, right? Plus, sellers want to see that you're qualified with that pre-approval. Also, what happens if the assumption doesn't work out? For whatever reason, timing is normally the issue. Are you willing to buy the home at its current market rates, right? Also, big thing that you have to consider is that you do have to bring in cold, hard cash to the closing between what the list price is and the assumable balance. So it might be $100,000, might be 50, might be 300. We've seen it as high as $1 million, so it really depends. Now, there is an option for second mortgages, which I'm going to cover a little bit later when we talk about servicing. Now, another thing that you want to keep in mind is that you take over the exact balance at the time of closing, and also the remainder of the mortgage. So an example is, let's say the sellers have a 24-year mortgage left on the property. Started with a 30. You are going to be taking over a 24-year mortgage, which is also a big benefit for you. This is why we kind of see property values somewhat skewed on assumable mortgages, because they give you, you're saving a ridiculous amount of interest, but most of the time it's cash that's going to be the issue. Plus, you're taking in a lower term, so you're benefiting from all of that. Especially if you're buying at market rate, it's a no-brainer to get one of these if you can get it. But the problem, I think, is that times sellers offer them, but they don't realize like how much it takes to do it. And even the VA says that this is more beneficial for buyers than sellers, but you might want to help a brother out and offer them an assumable mortgage so they can save money on their monthly payment. It's still a regular transaction, so you still have to put earnest money down on the transaction. So keep all of that in mind when you go through this process. And some contracts we see will have an assumable piece to it. And then if it doesn't close in a certain time period, then it flips to a regular purchase. All of those things, you want to be able to know what that is. And you definitely want to ask the sellers for what their balance is, because it's going to help you determine how much money you have to put down. And when you do the assumption itself, the mortgage does not reamortize. And what that means is that, let's say you take over a $400,000 balance on a mortgage with a 24-year lifespan left. You can't reamortize it to a 30-year and keep that same rate. So keep those things in mind, right? So that's part of that pre-approval process and the mindset you need to be in when going into this. Step 2, we're going to talk about what the seller needs to do. And this is a step that I think isn't started until much later in the until someone actually makes an offer on the property with an assumable. But if you're a seller, you should be doing this ahead of time. If you're a realtor, sellers should be doing this. If you're a buyer, this is what you need to tell a seller to do. All right, so the seller needs to inform their servicer, because they're the ones who handle the transaction, not a loan officer per se from an outside company. It's going to be the actual mortgage servicer of the seller that's handling the entire piece of this transfer. This is who you're submitting all your documents to. They are going to be taking over that process of the entire transfer all the way up to closing. So just be aware of that. Now, in this step, right, this is where you as a buyer come into play, because the seller is going to give your information to their servicer, okay? or they're going to have you fill out a package, which then you submit back to the servicer. Overall, we are seeing that the assumable process to kick off takes about 10 to 15 days for them to contact you, and then about another 45 days to close. Now, it's gotten much faster because the VA put a circular out because people were complaining, as they should, that it's taking too long. VA said, hey, 45 days. So servicers are doing really what they can to make that happen. Now, one thing to remember is that anyone can assume a VA home loan. It could be a civilian or a military person. They can, if it's going to be a civilian, or at least someone that's going to lock your benefits into the property, meaning you're not switching benefits. I'm going to explain that. Because even I, as a veteran, can assume someone else's mortgage without putting my benefits on there. I think it's crazy you can do that, but it's definitely possible. So let's say when you're, and I'm a caveat, a substitution of entitlement is when I'm putting my entitlement into your property and freeing your property up, and then you're getting your entitlement back. That's what's a substitution of entitlement. That's what that means. A release of liability is when you are being released of liability for that mortgage, right? So you could do a substitution of entitlement along with a release of liability. You do that together. And if you're not substituting entitlement, so you're locking your benefits into that property, then you're just doing a release of liability. So in the event something were to happen, like a foreclosure, you don't, that foreclosure doesn't go up on your property, but you will lose your VA benefits, or at least that portion of your benefits. So keep that in mind. Okay. So now let's just say no substitution of entitlement. You can purchase it as a primary residence, a second home, or an investment property. It's the only loan program that you can do that with. Now, if you're buying it as a veteran that's also doing it as a substitution of entitlement, or actually you don't have to be a veteran, because if you're a surviving spouse, you also have this benefit to be able to do it, so keep that in mind. So when you do that, then you're going to do a substitution of entitlement and a release of liability, and it's going to be your primary residence, so all those three things are going to happen. And just remember that you can have that same loan, unlimited assumptions later. So at some point, though, it's going to be tricky because it won't be worth it. You might just get a new mortgage. All right, step 3, you got to talk with the servicer. So that's you as a buyer. All right, so this is where you submit all your financial information. And this is why I mentioned going through the pre-approval process significantly helps you prepare for this. I mean, at least a good loan officer is going to walk you through that. If you guys need help, again, we do this stuff. We do it for free. As far as doing like the pre-approval, and if you don't do anything, there's no charges. So you could, in the description, you'll see our contact info, schedule a call with us. Happy to help with that. And also you want to be able to, have more for you to be able to submit to them than chasing documents from you. It just makes it a lot easier for you. Now, let's talk about second mortgages with the servicer. So yes, on an assumable mortgage, you can get a second mortgage or a trust, depending on where you are in the country. They call it something else. Now, normally, like we do them, you're going to be capped at a 90% collective loan to value, right? Which is going to be the total mortgage itself. So let me give you guys a good example of this. And I'm going to use a $100,000 price point because, again, I want to make the numbers easy. So if you're buying a property for $100,000 current purchase price and the mortgage balance is $80,000, typically in that scenario, you would be bringing in a $20,000 down payment. With this HELOC, now there's definitely minimums on these HELOCs. Normally they're like $50,000, but again, this is an easy example. Let's just say that you would be able to get a $10,000 second mortgage, assume the first mortgage, and bring in $10,000, right? So that's normally how it would play out. But this is a caveat that I'm going to explain. It's a little bit more advanced, but you got to know what it is. It's called a notice of value. So anytime a VA loan is done and an appraisal is done, the ASAR, which is like a VA underwriter, issues a notice of value basically, and this is what you're purchasing it for, and the appraisal correlates to that. Well, lenders typically, I haven't seen anyone go above it, so I'm saying typically, right? Cover myself, is that If you were to buy the same $100,000 property, but the original mortgage balance was $80,000, and for whatever reason it's $80,000 today, you would be capped at the 80,000 or 80% loan to value, and so you couldn't get a second mortgage. So those are things to consider. So in that same example, let's say balance is 50,000, but originally purchased at 80,000, you'd be only able to get a second mortgage up to the $80,000 if they allowed it. This is why you want the seller or yourself, if you're thinking about that, to confirm that so you know what that is. Now, with that being said, literally everybody I talk to in the finance and real estate industry tells you that you cannot get a second mortgage on an assumable mortgage because the second mortgage is not assumable. Well, they're wrong. All you have to do is call the VA Regional Loan Center and they will walk you through that process. But it's something I hear all the time. Jump on a call, call somebody, they'll walk you through it. All right, step 4 is the underwriting process. Now, doing your pre-approval, that's great. Talking with the servicer, you're starting that because you still need to be credit and income qualified for the assumption. One thing you do have to be on the lookout for is lenders having an overlay, meaning just because the VA allows you to be able to do the assumption, will the servicer allow you to do that? So this is why arming yourself with the right information and going through the right channels to get a pre-approval helps the process significantly. Now, there's some caveats to this as well. Remember, there's no appraisal done with a assumption. If you're getting a second mortgage, there will be a appraisal done, so also keep in mind. And a termite inspection is not going to be required. If you're buying a condo, then again, you're just assuming it. And also, I'm assuming that the condo is already VA approved, or if it was denied, a waiver was authorized by the VA to make that happen. So that's going to be through your underwriting process. Now, you're going to be working with most likely a loan officer. They're going to be going back and forth with you on different things so you can get all the documents together. If you get a denial, I wouldn't worry about it. If this has just happened to you, feel free, reach out to me. I'm happy to do it. Again, I'm not charging you. You might do it. I want to help the veteran community. Unless we get like 1,000 of these a day, we might have a problem. But right now, that's not the case. So hit me up. All right, let's go to step 5, final step. Now we're getting to closing. So a couple things to remember from earlier. One, you're assuming the remainder life of that mortgage. And so if it's 25 years or 26 years and 5 months, that's what you're assuming at that time. You're going to assume the balance of that on that day of that transfer plus any escrows that's in there. Remember, you can't put a down payment on an assumable mortgage. You can't reduce the payments. And you do need to have full entitlement of the original purchase price of the sellers. I'm going to cover this. And I didn't mention it earlier because it's just a lot to take in. Okay. Entitlement is not based on your current mortgage balance. It's based on how much you originally took the mortgage out for. So if you took out a $500,000 mortgage and your current balance is $300,000, as a seller, you have $500,000 of benefits locked out. As a buyer, you must have $500,000 of entitlement at least, and you can't do a down payment like a normal VA purchase would when you have multiple VA loans. So again, keep all of that in mind. Now, a couple things to know. You're still paying closing costs based on the purchase price, not the difference between the assumable loan and the purchase price, right? You would think that you would save money if it was the other way around, but you still have to pay regular fees like title and government fees based on the total purchase price. So keep all of that in mind as you go through this journey. Hey guys, please smash the like and subscribe button, and I'll catch you guys soon.